more and more also the investors want to know what impact they create with their money.
Welcome to the Mastering Complexity podcast, making sense of complex topics. We're joined today by Mr. Patrick Werth. Thank you so much for joining us today.
Thank you.
Well, let's jump right in. So you're managing ESG operations and modules and all things sustainability here at Swissquant. And so I'm interested to hear from you a few different things. I want to know how you got into the industry. I want to know your take on upcoming regulation, Swiss-based, European. There's a bunch of different competing jurisdictions here, very complex. So why don't we start just with a little bit of your journey in the financial sustainability space?
Sure. Well, after my studies, I pretty much jumped directly into that industry, starting as a company analyst, doing some environmental assessments of investment candidates. Then later on, in that position, we launched the first sustainable fund of ESG funds in the German-speaking markets. And then later on, I spent 10 years for one of the bigger ESG rating providers, doing business development in the German-speaking markets, but also in some business areas European-wide. And then I took another step into more the communication side of things for an insurance company in Switzerland. And so as you can see, ESG is a bit like a golden thread through my career.
Right, absolutely. Now, sustainability, ESG, SDGs, these are very hot topics now in the space. But I mean, listening to your background, these aren't new. This has been a focus for, would you say, at least a decade?
More. If you look at Switzerland, it actually started about 30 years ago when there was a chemical accident at the Rhine River, and there was a private bank, the Bank Sarasin in Switzerland, who then decided, like, well, this kind of thing it's impossible that this happens just in front of our headquarters. And that was actually the key moment when they started to think about how they can avoid things like that, and if there's anything they should adjust in the way they invest. And that was the start of, let's say in Switzerland, of the first, at that time they were called SRI products, for social responsible investment.
Gotcha. Okay, now here in Switzerland, we're sort of dependent on a couple of different regimes here when we think about sustainable investments. Of course, we've got the very Swiss-specific ones, and then also due to, customer overlap and geographies, the EU regulations are also relevant. Yeah. So I'd love to get your take on the differences between these two approaches. I mean, I know 2023, this is a big year now. There's a lot of regulation just around the corner. And it looks like, early 2024, we're going to see the hammer come down a little bit with both in the Swiss and the European context. So maybe you can tell us a little bit. Let's start with the Swiss approach. What's going on right now, and what do banks and wealth managers, asset managers need to be aware of?
The actually interesting thing is that both regimes have the same starting point, because it's the ratification of the Paris Agreement, where member states made commitments to change something. And the European regulation, they were just a little bit faster in going forward. They were actually a bit on the forefront, even if you look at this in a global context. And Switzerland was a little bit observing, but in the end, Switzerland is doing something very similar, just with a 2 years delay, I'd say. But there are significant differences because it's much more pragmatic. The banks have more freedom to implement ESG in a much more tangible way. That's what I want to say, and provide a nice customer experience.
Perfect. So what would you say, we've got these two different regimes, the EU and here in Switzerland. The Swiss-specific approach, how would you compare it to what's happening in the EU?
Yeah, sure. The Swiss approach is much more pragmatic. It's less based on very strict technical approaches, how banks have to do something. So they are much more free to choose an approach which is in the end is much more end investor friendly. Then they can make ESG more tangible, actually, in a pretty nice way. In comparison to that, in Europe, there are very strict rules how they have to capture the ESG preferences of a client. But this is the core, right? So capturing the ESG preferences, that's what both regulations are about, and making sure that they match that with the investment portfolio or with whatever the banks do advise to clients.
Okay, and if we zoom in a little bit further, let's keep it in the Swiss context again. It sounds like the regulation is allowing the banks to get to the end results, as you said, more pragmatically. So they're not coming down and over-regulating the method, let's say, but the end result should be the same. So what is that end result, especially looking towards the end of this year, 2023? What do the Swiss banks, the Swiss asset managers, wealth managers, what are they going to be required to do?
The end result is the same in terms of that there has to be a certain procedure and more transparency. But the end result, when it comes to how the actual investment looks like, there might be differences between the Swiss approach and the European approach. But what they have to do in Switzerland is start with, it starts in 2024 with new client relationships. It starts 1 year later with existing client relationships. But what they have to do is when they advise a private client, they have to raise that sustainability question. So they need to ask the client whether she or he is interested in ESG investments. So they have to explain what that means and how they define ESG. And if the answer is a yes, then they need to have a process to explain ESG and also to make sure that these clients' ESG preferences are captured accordingly, and that there's a process to making sure that whatever they advise or recommend to the client to invest in is matching with the ESG preference. This has to be documented. If the bank cannot 100% match the ESG preferences of the clients, they also need to document that and inform the client about any gaps. The client can still say, yes, that's fine with me, or go through the process again and choose something different.
So in 2024, starting, all new clients will have to be run through this process. And as you said, existing clients, this will be pushed a year later, but then they'll be treated the same. There'll be sort of a retroactive analysis of interest there. Okay,
right.
Very interesting. And in your experience in the Swiss context, do you think the regulators will be looking at this 1 or 2 year period as a sort of a sandbox, proving ground, figuring out the best practices, and then will they likely come back with more explicit rules and processes, or do you think they'll keep it a little bit more hands-off?
I'd expect that they keep it a little bit more hands-off, but since the authority also clearly made greenwashing like a key topic and something they want to watch out for, I wouldn't be surprised if they pick an investor or a bank or so where they do not really comply with the regulation and
sort of showcase the issue and sort of bring some light on someone that's not following what they're doing. Okay,
yeah,
that makes sense. And so that's talking about preference capture and offering different sort of avenues for sustainable investing. And you were mentioning too, this really all has to be, the processes, there's got to be a lot of documentation. What about regulations in the Swiss context for reporting on this in general? Are there some requirements there in place already?
The Swiss regulation is not very precise. You can have a rather simple capturing process or go a more sophisticated way. And it, of course, makes sense to adjust the final reporting accordingly. If you have a simple preference capturing process and you come out with a super fancy reporting that goes into many ESG details, it's kind of a mismatch because you would anyway not be able to go back in the loop and manage certain things that you might not like in the outcome of the report. So I'd say it goes hand in hand. But there will be also banks that choose to provide, let's say, a more sophisticated capturing approach to their clients, and they will definitely also showcase in the report how they implemented that by maybe introducing some impact measurement indicators or portfolio temperature, things like that.
Gotcha. Okay. Let's shift gears a little bit and look at the EU approach here. Now, this is relevant, of course, for anyone, at least in my understanding, anyone dealing with European citizens, anyone that has clients within the EU. Let's talk about the differences here between the Swiss approach.
Sure. Yes, it's relevant, as you said, for all banks dealing with EU citizens or having a branch in the EU market. And the main difference is that the whole capturing process is based on 3 predefined approaches, or let's say things that are clearly regulated in new law that came out or has been amended in the EU. The first thing, it is the concept of the principal adverse impact indicators. That's a very predefined set of indicators telling us something about to what degree your investment impacts sustainability factors. And then the second approach is the amount of so-called Article 8 and Article 9 products, how the EU is defining sustainable investments. And so you have to give your client the freedom to choose to what degree these kind of products should be considered. And the third one is the alignment with EU taxonomy. The EU taxonomy is something that connects these different pieces of legislation, because this is the first ever clear definition of digging into certain industry or economic activities and defining whether they are considered as sustainable or not. I'd say the threshold for that is pretty high. Even if you look at the ESG funds that have a clear ESG intention as of today, even if they have climate-related intention, also those struggle at having a decent alignment with EU taxonomy. So there's a lot of work to do, but also a lot of expectations to manage. So if you as a private investor think like, well, my portfolio should be 100% aligned with the EU taxonomy, there will be almost no investments left to do.
Right. Okay. So quite a wide scope. It's going to, sort of a wide regulatory net, going to be capturing a lot of what's going on. And what about the timeline on this? Of course, we mentioned before, 2024 is a trigger point for the Swiss regulation. What's happening in the EU?
In the EU, the capturing of the preferences already started last year, on the 2nd of August. And the other parts of the timeline, they are not so clear, because the different pieces of legislation, they have different starting points when they become applicable. And they also have some transition period.
Transition period, yeah.
And the one important thing is also that in the European context, the legislation is also affecting the real economy, which means companies are forced to become more transparent in ESG reporting. And this seems like to be the starting point of this whole value chain, but the investment industry is like a step ahead of that. So we have a lot of regulation. They know what to do, but the companies are a little bit behind with reporting in order that this is going to work, right? That also means the process has started. It's not perfect, but these gaps, or these information gaps that we have today, the industry is struggling with them, but we also know that they're going to be smaller in the future.
Gotcha. Okay. And speaking of information gaps, let's just jump in to ESG in general. We've got E, S, and G ostensibly treated differently within the regulatory context as well. What can you tell us about this breakdown, these 3 avenues here?
Yeah, sure. it was quite obvious that the E was prioritized in the regulation context, and I think can also be explained easily because it's almost easier to measure, to quantify it. It was the main topic of the Paris Agreement, right? It was all about climate, which is part of the E. So this is where the regulation started, but they have also included something which they call social safeguards. That means a sustainable investment, according to the EU definition, it's only sustainable if it fulfills an E objective, but at the same time doesn't severely violate an S or a G dimension.
So it's sort of held to a bit of a higher standard. The focus, as you said, is really on the environmental aspect, but at the same time, an investment will only be considered sustainable, if you will, if it doesn't prejudice the social and the governance aspect.
That's correct.
Okay.
That wasn't very visible in the beginning when this new regulation was discussed and introduced, but it more and more became obvious that this is part of it.
And what can you tell us about that process? I mean, as the EU legislation, as you mentioned, is already in practice right now, at least a part of it. What can you tell us about how the governing body, the apparatus within the EU, sets up these initiatives, orchestrates these regimes? What can you tell us about the process?
Yeah, they basically started with something they called high-level expert group on sustainable finance, where they put together a group of industry experts from different areas. They work with public consultations and the industry associations of all the providers of financial products. They for example, they gave their feedback in this process. Many other bodies like all the industry associations, even NGOs, etc. So all this feedback was collected, and that was a crucial part of how this regulation was developed.
Gotcha. So there's a pretty strong consultation period then, I guess. Okay, great. So then we've covered a little bit of the regulatory side in Switzerland and in the EU. Something that's very important, of course, is choice of data provider. What can you tell us about how that's working right now, especially in the E, in the environmental context of ESG? There's a number of different providers out there. What do the metrics look like? Are they comparable? What's your take on that?
Yeah, I mean, in the end, I'd say there's about a handful of really established data providers that have a certain track record, that have decent capabilities to collect all this data, process it accordingly, and come out with meaningful data sets, which can go from the typical ESG ratings, where you make an assessment or to what degree a company is prepared to manage ESG risks and opportunities. Then there are data sets which are very much climate related or more impact related based on the Sustainable Development Goals. And then there are new data sets which have the EU regulation in focus, like the Sustainable Finance Disclosure Regulation.
That's the SFDR. We've heard about this.
Correct.
Before, yeah.
Part of the SFDR is this set of indicators that we call principled adverse impacts.
Okay, it all comes back together. Gotcha.
Yeah.
Okay, cool. And so, I mean, the climate-related metrics, this makes sense. I'm interested, how are companies approaching the S and the G aspect? What are they looking at there?
In the S aspect, I mean, you look at things like adherence to human rights standards or labor rights, best practice, etc. And also the human capital in companies. I mean, I'd say there are up to 100 indicators only in the S space that these rating providers look at.
Let's focus in then on, we've talked about some national, supranational, let's talk international now, moving towards the UN's SDGs, the Sustainable Development Goals. This is sort of its own creation, but somehow it embeds itself as well into at least the EU framework, if I'm not mistaken. Is that right?
The EU and SDGs, they were initially launched actually for states. But very quickly it became obvious that the framework itself makes use in different contexts. It also makes use for companies and how they operate, and then for the financial industry on how they look into what companies are achieving towards contributing to sustainable challenges globally. I mean, here we're talking about areas like reduction of poverty, health, well-being, clean water, clean energy, things like that. But as said, initially it was actually made for states, and now it has been quite established also in the financial industry. The good thing is that it's very global. It's not like a European thing or a Swiss thing. And companies also report or use that framework for their own reporting. So if you go to a company and speak with them about SDG number 5 or 6, they know exactly what you're talking about.
Right.
So it's quite universal, and it's a helpful instrument to measure impact. And impact is something which is still an ongoing debate in this industry and also in academia. But it's very clear also that sustainable investing is not only about excluding a few companies or emphasizing some good ones. It more and more also the investors want to know what impact they create with their money.
When you're talking to these companies, these banks that are looking to get on board with the regulation, what are some of the main topics that they're struggling with? Is there something in particular that's tough? Is it just the disparity? There's regulatory overlap. There's a bit of confusion. What's sort of the main topics?
There are a few topics. One is definitely that the advisors are not yet ready to speak about ESG with their clients. Then there's a lot of training to be done on making them fit to speak about this topic in general. Another topic is definitely the data, how to handle data gaps and the amount of data, but also that feeding that into a advisory process that on one side is compliant with regulation, but on the other side still simple for the end investor. And I think this is a really challenge.
Okay.
Pretty sure that we'll see a lot of banks that go for a very simple approach, which is also okay. An approach can look simple from the outside, but be very proper under the hood. So it's, if you have a proper process, how you define sustainability and have a process on assess your investments accordingly, you can still have a simple process on the surface where you only let your client choose, do you want more or less sustainability on a scale or categories in 4 buckets or so. That doesn't mean that you have a proper ESG assessment in the background, right? So I think that's the nice thing about the Swiss regulation, that you don't have to make it look so complex and technical for your clients. But if you are a sophisticated player, you can have a very strong ESG setting in the back.
Right, you can position yourself in that way. Now, in the Swiss context, who is the regulatory body that's going to be overseeing the banks and how they approach sustainability?
In Switzerland, we speak about self-regulation. It's the Swiss Banking Organization that came out with a guideline, and they just simply say that this guideline is mandatory for all the members of the organization, which is basically every bank in Switzerland. And that's what makes this guideline a self-regulation. And for the banks, it's the new Bible. It's what they all are now focusing on and thinking how to implement it properly. We have similar self-regulation for the fund industry. There's the AMAS that came out with also with guidelines and also saying that it's mandatory for all the members.
Which organization, sorry? AMAS?
The asset management organization.
Oh, okay. Yep. So there too, they're getting captured by this as well. Okay. Yeah. But it's still, as with many things in Switzerland, it's a more of a decentralized approach. A lot of SRO sort of input there, self-regulatory organization.
I wouldn't say it's decentralized because it still comes from one official body. But yes, it's not. It's more vague kind of than the European approach, giving more freedom to the market on how they implement.
Now, your personal sustainability journey, you walked us through a couple of your past positions, more than a decade experience here. If you can think back to when you first started in this industry, where did you think we'd be by this time? And are we exceeding that, or are we lagging behind from what sort of you in the industry had the forecast for 2023?
In my opinion, we are exceeding. I started 20 years ago, and I would not have expected this amount of mainstreaming. 20 years ago, the sustainability people, they kind of thought that, our personal goal is that at some point that the industry does not need us anymore, or we can get rid of our jobs. We had maybe 50 years horizon, and now it's actually happening very fast, but it's happening so complex that we're not going to get rid of our jobs soon.
Right. Okay, interesting. And has anything stuck out to you along the way in the 20 years you've been involved here, besides maybe, I guess, the speed and scope, as you mentioned, is exceeding what you were thinking? Any other takeaways here, or any issues that popped up that you didn't foresee, whether in the sort of the data space or anything like this?
Yeah, the data space, I wouldn't call it issue, but something that was a little bit unforeseen is two facts. The first one is that we had a lot of pioneers in Europe in the space of ESG data collection, providing these ratings and services. And almost all of them were acquired by big US companies like MSCI, S&P, Moody's, Morningstar. That I would not have expected to happen. And the second thing is this low correlation between the different ratings. We know that the correlation is somewhere between 0.5 and 0.55, 55. So it's really low, and I always knew that it all depends on how you define the topics, where you set thresholds, what data you're capturing, how you process that to a rating, but I would not have expected that low correlation.
Yeah, that's really interesting, actually. I'd love to just zoom in on that a little bit more. Why do you think that's the case? What's going on here? I mean, there's a consolidation, as you mentioned, in the market, but then the output is so disparate. Why do you think that is? They're looking at different metrics.
I think it all has to do with ESG being a little bit more complex than if you look at a classical financial rating, the kind of topics or incidents you look at there. Whereas in the ESG space, it's really more complex, and the methodology to collect all this information, process it in a meaningful way, to come out with a rating, just allows to go that in different directions. It's something that the regulator is looking at the moment because, it's something that the industry is also struggling with.
Yeah, that makes a lot of sense. Now, in the regulations themselves, is there any guidance as to, have they built a pool? These are authorized data providers, you're free to pick from this group, or is it also quite open? You just sort of have to have some sort of data-driven analysis happening.
I think, in my opinion, a clever way that the regulator here takes is that it's in the future it's less about ratings of companies, but if you look at it from the pure regulation angle, what the EU regulation is asking in terms of ESG information, and that's exactly what they achieve with the principal adverse impact indicators, is that you don't capture or measure in terms of scores anymore, but you go back to more raw data of companies. So if we look at climate, then the metric is CO2 equivalent, or tons of CO2 equivalents, and it's not a score which is somewhere between 0 and 100 with a lot of variance how it's calculated.
Going back to the raw data, okay. And is that sort of the industry is pivoting back towards this idea? Sort of, they've seen the issues of these complex ratings and looking like we're going to be moving back in that direction?
I think the industry understands that the ratings are still valuable, but it's not the only source of truth. To have a holistic picture of ESG, it needs to be combined with something more.
Very good. Now I'm curious, do you have any insights into the appetite for ESG and sustainability from the bottom up, from the investors themselves or the banking clientele? Do you have any insights there in terms of percentages of interest or how that's been evolving over the last years?
Yeah, I mean, there are a number of organizations that collect these market figures, like the development of sustainable assets on an international level or European-wide, even globally, and they all point in one direction, right? So it's a massive increase every year. It's not so easy to capture that, because also here it depends on how you define a sustainable investment, of course. And with the new EU regulation, this all takes like a new definition, and you could almost scrap all the statistics from the past and start collecting from zero. But it's also very well known that a lot of high net worth individuals, they are complaining that they do not get the ESG advice that they would expect from their banks. But this is known since for a couple of years, and I think the banks they know it. They are trying to get better, to educate their staff, their advisors, creating better sustainable investment offerings. But it takes time.
It takes time. Now, one of the main issues within the sustainability space, and you mentioned it briefly before, is this idea of greenwashing. It's this intransparent situation. How much of that do you think ties back to the creation of these scores rather than the raw data?
I wouldn't blame the scores for that, because as said, the scores, they are still very valuable to have a basic understanding of the ESG characteristic of a company and how well the management is dealing with ESG topics. So they are basically a good thing. I think the greenwashing comes more from not properly understanding what these scores exactly measure, for one reason. Another reason could be that banks or the providers of financial products, they just make promises or maybe are too enthusiastic about ESG, but struggle with keeping that promise.
There's a lot of different ways to get to the problem, I guess. Okay. I mean, just listening to you here and talking about this industry pivot back towards the raw data, for me, that seems like it could clear certain things up rather than just this overall reliance on a score, which can be as you mentioned, valuable, but maybe a little bit opaque in terms of how a score was reached.
I mean, also important is, if you want to make a sustainable investment, it's not about picking the companies with the best score, because they are already high up or higher up on where they can be. But yeah, I mean, you can also intentionally pick companies with a lower score and see if you can influence them to become better. I mean, that's what the asset owners and the big institutional investors do a lot. And in the end, which one do you think creates a more sustainable impact?
Yes, very good question. I would say, yeah, tightening up those that are lagging behind. I would think there's a lot of work to be done there, especially, I guess, in, the commodities space, things like this, these industries and financial products that historically have, major, whether it's environmental impact or human rights capacities. So do you reckon then, on the back of some of this regulatory push, we'll see a general sort of global elevation in terms of where a lot of these products are now or companies are now? Do you foresee this having a general positive impact over the next 3-4 years?
It's a lot about improved transparency, and it will have an impact, but it's difficult to quantify today how much that will be. We've also seen banks running with high speed, being very enthusiastic, and are paddling back a little bit to classify their products maybe not as that dark green, but more of a light green, because they also maybe got cold feet when they saw certain greenwashing scandals coming up, and say, okay, let's be on the safe side and don't make too many promises. Yeah.
Don't make too many promises. And I guess, would that be your advice to asset owners or the banks that are looking to invest? How would you advise them to be able to best avoid the pitfalls of running into greenwashing?
I think when you implement an ESG strategy, there's a Pflicht. So that's the things you should really do to have at least certain minimal standard, and just don't neglect that. The problem is, if you neglect the Pflicht but go to the Kür and you try to do some fancy stuff without doing the must-have stuff, then you clearly risk greenwashing, because you're leaning out of the window a lot, but forgot something which is very crucial.
The fundamentals, getting the fundamentals right is the first step.
Yeah.
Okay. That makes a lot of sense. Cool. Well, Patrick, thanks so much for joining us today. Really a lot of insights here, and great to learn more about this hot topic. So thank you very much.
Thank you too.
Perfect.